There are increasing numbers of people asking the question as to whether or not we are at or approaching a market top. There are plenty of commentaries around this, but let's get an updated look now from a technical point of view in the markets and see what supporting evidence there is, either for a continuation of the rally or that we are already at the top. Ron William joins us now from RW Advisory. Ron, good to talk to you again. I know in the next 10 or 15 minutes, we'll be taking a look at some of the charts we've already looked at the back end of last year, and it'd be interesting to get an update from you as to where we are in terms of this question about a potential market top. First up, just explain what's happening.
Well, Happy New Year, especially to many of those that managed to build profits from the second half of last year's strong bounce back rally. Our opening slide is pretty much the global ranking model, which is at the heart of the process at RW Advisory. And essentially what it shows is a kind of a cyclical play, bifurcated cyclical play, where oil is top ranking and has been ever since that V-shaped recovery second half of last year. But Dr. Copper is falling from grace, so potential warning sign in terms of weakening growth to come. In the equity space, Asian equities is outperforming the world, led by India, Japan, and that's part of the long-term story, which accelerated through the pandemic mitigation. What's interesting is that China is actually maybe losing some momentum from that story after a short-term reversal from a 10-year ceiling. And the US, more specifically to our discussion today, is underperforming the world despite the historic highs that we've still clawed onto. And the big call is this Q1, or at least the very first half of this year, risk cycle according to our models. And just last but not least, gold is at the bottom of that ranking model on the left. Not because gold is downtrending, but the gold trend is actually still resilient. 3-year rising trend above the 200-day moving average. And the dynamic support is at 1823, and this is part of a multi-time frame cycle approach.
Okay, let's move on and move on to the second chart, because this is where we get into some more of the more familiar technical analysis. And you are comparing where we are now with earlier on in the century. On the left-hand side, you can see there from the year 2000 onwards, and most recently some of the months that we've seen going into the back end of last year. What about the Y2K against where we are now? What lessons should we take away from 21 years ago?
Well, history rhymes, but doesn't always repeat. And last time we looked at this was actually pre-US presidential elections. We now have the clear and official winner of President Biden. But what's interesting in terms of both event risks, Bush-Gore in 2000 and Trump-Biden now, is that we had a regime change of sorts, not least here and now with the whole COVID situation, which is for the most part normalizing, but still there are issues, like, for example, mutations and the vaccine rollout as to how viable that will be and the behavioral patterns that will follow through. But ultimately, we're at this tipping point, we're at this regime change, and that's what we saw in Y2K. And so it's a late cycle top pattern. The difference now compared to then is that we've actually popped above the ceiling of that top pattern in this exhaustion rally, which has lost momentum. And if it were to roll back lower under 3,600, that risk level, September peak high, which is when we spoke about the interim market top last year, back below 3,600, and then ultimately the pandemic gap. So that's the actual footprint in the market just before the crash of 2020 at 3340, 3280. Those two levels will suggest that there's a top pattern late cycle play, and it could be a deep volatile correction or crash situation this year.
What of the on the far right-hand side of this particular chart, you've got two boxes, one yellow, one pink. What is it that is indicating? You've got repeated those numbers out earlier on the left-hand side of the chart as well. What is it that they're telling you? What is it that they're implying and telling us?
Yes, so these are unique macro cycles, and when they appear in close proximity, it's a confluence signal, so a high probability market move. Now, back in Y2K, these printed twice but spaced apart, and that actually was a signature signal of a market top crash situation. This year we've had a similar variation. The first cycle has already happened, and we continued to higher, but at a lower rate of change. Right here and now, we're approaching the second and more important cycle, which tends to be more risky in terms of overbought market like the one we're in. So watch out for the month of March as we shift into the end of Q1 onto Q2 for potential shakeout moves in the market.
Okay, so moving on now to the next chart. You've got a roadmap of the boom-bust cycle. And I know this, I think, relates to your colleague, doesn't it, Robin Griffiths, who uses this as his roadmap.
Yes, so my industry colleague and mentor, Robin Griffiths, has been using this for just over 50 years in his illustrious market experience. And essentially, exactly what you said, it's an educational framework for the boom-bust cycle, primarily based on the decennial 10-year economic roadmap. And the key message here is that we are highly likely in a late cycle phase labeled WXY. It's a three-stage phase. From a market point of view, you can think of it as a crash signature pattern, which breaks down into a fall, rally, rest of fall. When you zoom in, it looks like a V-shaped recovery, but often it's a false V-shaped recovery that turns into a rolling W retest of the crash lows. That's textbook style. But of course, markets don't fit textbook examples all the time. And last year, going into this year, was a case in point. There was it was a bifurcated market. Winners, losers, K-shaped recovery more specifically, and you had countries like the US winning out, sectors like tech also leading the way. And so for that reason, we decided to resort to an equal weighted index, which is the chart that you see on the left. That's also played catch up and made historic highs. But what was really interesting for most of the second half of last year, 4 months, we had a negative divergence. So we're looking for that to show any signs of weakness and a potential rollover to indicate that the broad market is weak and potentially giving us that bear correction crash signal. So look at the equal weighted index just because there is so much of a bifurcated nature to the market that we've been experiencing.
Okay, let's bring it up to date and take a look in some more detail about what we've been talking about in the markets recently. And this is this elevated level that we've seen recently in the volatility index. So as I say, let's bring it up to date and get you to introduce the next chart.
Well, yes, I mean, for all this time, since March last year into now, it's been a greed trade. The pendulum has swung from fear just before the pandemic to greed. And the last time we spoke about this was when basically we had the infamous options market based on the put-call ratio hitting historic extremes, and that was elevated in the tech sector. We had smart and small money highly leveraged in big name tech sectors, and we also had kind of paradoxical crisis opportunity trades like the Hertz stock being highly levered. And now what we see is an evolution, a new evolution of retail money turning into more sophisticated strategies where they're actually shorting lower quality stocks with negative earnings and high debt. And essentially they're almost pitting themselves against the big money smart hedge funds. So this is a chart from Goldman Sachs showing an index of the top 50 most shorted stocks. And you can see the rocket launch at the top end of the right side of the chart going into early this year. So, I mean, it clearly would have been beneficial to those that made money and managed to kind of front run that trade. But a word of caution, due diligence is key in late cycle setups, especially where liquidity can become an issue. Obviously, there are also regulatory issues here, which will likely change the rules in order to avoid situations like this, particularly when companies can get hit hard. And more specifically, from a technical analysis and behavioral point of view, let's learn from the greater fool theory. everyone's smart and everyone's right when you're trading on the same direction of the market. But the moment that last buyer buys, that becomes the greater fall, which then of course leads to the bubble burst.
Yes, and this is interesting, as you say, from Goldman Sachs data point of view. But in terms of the volatility index itself, you've got this next chart with a quotation, "Eye of another storm." How likely is that we're looking into another storm at the moment?
Highly likely, and I think last time we spoke about this, it was a lower probability, but it was still kind of a building scenario based on historical rhymes of the VIX. Looking at the last few years, mean reversion is a traditional signature of volatility and the VIX. And more specifically, if you look at it from a pattern perspective, you had this compression breakout pattern that Jeremy, you and I have been talking about for some time. And the biggest one was just between 2016 into 2018, where we had the spike margin call in Q1 and then Q4. But of course, the almighty one was the one that actually led and exasperated into the 2020 COVID-19 pandemic. Right here and now, we've been within a range between 20 and 40, and the recent market shakeout, although it's been relatively capped so far, we did have a shakeout, but it did cap. It is looking like another breakout pattern to the upside, i.e. rise in volatility, and ultimately from a sentiment point of view, fear, not complacency, which is what this index shows at the extremes. And of course, a potential eye of another storm to come. Now, if what would negate this view is if the volatility index were to break below 20, that hasn't happened yet. And if you look at the behavioral psychology of the pattern, it looks like a W shape, a setup in volatility, and that just skews the probability much higher for a breakout in volatility in the coming weeks and months. Also,
sorry, go on.
Yeah, if just one last one. If you look at the charts on the right, the small inserts, you can see, implied volatility is elevated, and it's always good to look at the futures market to see what they're pricing in ahead of time. And from a historical point of view, there continues to be rare asymmetry in the market, where you have all-time record highs in the equity market, and VIX is also high. That is unusual and usually a late cycle signal.
What about January? How important is the month of January to give us a steer on the rest of the year?
Well, according to the stock market almanac, they've tested this back 100 years plus. It's a useful but not entirely predictable seasonality tool. Now, this is one of many parts of our toolkit from a timing and seasonality point of view. And you need to blend the qualitative and quantitative filters together, which is what we do. We look at the stats, but then we also cross-check it with the actual chart setup. So that way we've got the mix and the high probabilities view. Now, what this chart shows is a quadrant of scenarios. So first things first, the January barometer is not necessarily a binary outcome. More typically, a strong January means a strong rest of the year, which is why you see in the top right-hand corner, there are more statistical sample points over history, because the market's generally been up, I think 67% of the time based on the Dow Jones history. So there's a positive skew, strong Jan, strong rest of the year. But very interesting point that you can only really make from a qualitative point of view. You need to go back to the historical analogs of market tops or overbought volatile cycle points. And what you'll identify is that some of the historic tops, including last year, by the way, 2020, we had a strong Jan, and then suddenly we had a big cliff drop in the market in Feb and March. So be aware of the paradoxical negative surprises that can happen. This month of Jan has also been a great example of that, because we started strong and then suddenly we had this spike in vol. Just be aware of the potential pain trades. And I would say this year, more than any other year, because we have most mainstream narratives actually looking for a roaring 20 setup, supported by a return back to some new normal in terms of the vaccination rollout, and people going back to some kind of old trend. But look at the flip side of that. One of the things I teach from a behavioral point of view is looking at the bull-bear case, and the bear pain point case to this blue sky story is the mean reversion risk in a late cycle setup, virus mutation. We're here in the UK, and alongside South Africa and Brazil, we're kind of got variations of the same concern. The behavioral patterns have shifted. So even if this virus goes away and the vaccine is the miracle cure, ultimately, how will this situation change consumption trends? And let's not forget, interesting statistic, looking at SARS as a case in point, which is a much weaker virus comparison, that led to behavioral changes in consumption patterns for just over 3 years. So will that lead to a weaker economic trajectory, and ultimately, anything that might come from that in terms of socioeconomic or even geopolitical risks, which we're starting to see in parts of the US and parts of Asia? I'm just laying it out there as probabilities, positive or negative, but more on the negative side, since we seem to be crowded out on the opposite side. January can give us a surprise setup into this year, particularly looking at the technical and timing setups that I've been discussing.
Well, let's now take a look at this in the context of, for example, the S&P 500. If I switch the charts on to the S&P, you've actually gone into this with a chart here, asking the question whether or not we're going to get a final sort of blow off, if you like, on the top before we get a fall. But I would point to you the potential for further upside from where we are. Explain what's going on here and how the exhaustion top pattern works.
Yes, and this is predicated on the economic framework of the MINSKY moment, formulated by the American economist Hyman Minsky, and it's all about stability leading to instability. So when we least expect it, when the bull market is roaring and there's plenty of euphoria fueled by liquidity and low interest rates, as a case in point, you tend to get these overextended record-breaking bull markets. And this has been the case since 2009. And so that's what we see, this monthly chart going back to 09. Now, interestingly, the pattern that we're looking at is the technical framework of the Minsky moment, and this has been a big market call that I've been making since the summer last year, and we're still in play. It's broken above the trend support, so that does bring it to question and maybe neutralize it a little bit, but we haven't moved too much away from support. So there are two scenarios here at the moment. We either extend a little bit in this what seems to be exhaustion rally up into 4,000, big roundophobia level. Either that becomes a glass ceiling and we continue higher, in which case this pattern gets negated for some time in the near future, or that's an exhaustion rally which later on falls under its own weight. And then the flip side, a more preferred outcome based on the technical pattern, is an imminent reversal, and that would need to be a decisive one. To give a strong confirmation below 3,600, which is the risk level that we showed on the original chart at the front. That would also lead to a break below 3,280, which is around about the 2018 prior record high. And all of that would confirm not just a top formation, but it would also suggest a major bull trap reversal signal, which would basically imply a much faster and more violent correction and arguably crash signature. And that's within this exhaustion pattern, which basically shows a massive imbalance between demand and supply. That's a self-feeding volatility cycle, and that just feeds more of this high-risk asymmetric situation.
And of course, onto the final chart, and the big question here is, of course, the economic backdrop to this is we've come out of a COVID crisis. We're hopefully now emerging from that with these vaccines. It has yet to be demonstrated just what effect this is going to have in terms of the outlook for growth and for inflation and so forth. So put your charts into some sort of context in that regard.
Yes, so I thought the grand finale chart needed to be the bond market. it really is the most important proxy to watch this year and just going forward. And more specifically, look at the credit market for any kind of early signs of escalated risk. Particularly as we go into this so-called recovery, it's potential recoveries from heart attack situations like the ones that the market has been in since last year that usually triggers a correction or a crash situation. And if we look at this bond market chart, looking at yields, this is 10-year yields, US now versus the 1930s. Whether you agree with this analog or not, the important point is to keep in mind the risk of an increase in yields. We've already seen a sharp rate of change increase year to date. And if that were to accelerate, especially if it's fueled by any kind of insolvency situation, we could just get a simple analog like a 1.5% spike risk or thereabouts, which is what we saw in 1931. And that is a deflationary spike, default driven, which ultimately resolves back down, so potentially back into a new lows for the yield, long-term yields, before a multi-year reversal. Essentially, it's something to keep in mind as part of the MINSKY moment risk, as in terms of the irrational speculation and the amount of liquidity in the market. Interesting quote that I would like to make from leading UK fund manager Jeremy Grantham. There's actually talking about the moral hazard and the day of reckoning after the 1.9 trillion COVID stimulus, which is now leading to a US budget deficit greater than the World War II level. So that's why this analog is actually quite useful. Any more risk that we have from the debt situation, not from a liquidity point of view, but from a solvency point of view, in terms of businesses, sectors, and credit spreads, is going to create a cascade effect and a potential deflationary spike in yields, which would be the kiss of death to a lot of the irrational exuberance that we've been seeing to date.
Yeah, fascinating story. As I said before when we've spoken to you, and as this is a developing story, doubtless we'll be back with you a little bit later on in the year to see how things do develop. But Ron, in the meantime, thanks indeed for joining us for this update on your thoughts on whether or not we're at or very close to the market top. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.